we're going to have a talk about dollar costing in. So if you have any questions along the way, is feel free to ask, yeah, because I know people have been engaging with it, and I just want to go through it in more detail and just make sure people understand how best to use it, and how adaptable it can be when you do use it. So let me just, I don't have so much of a screen to share today, so to speak, because we're more talking through this. But let's get the conversation going. And again, if you've any thoughts or questions, hop in, because it's getting into the nuances of it today. So dollar costing in, I know everybody basically understands, is that you're putting a small amount of money in and that you're gradually, incrementally increasing more funds into the trade as it goes along. So that's understandable. So where are the pitfalls? Is one of the pitfalls is if somebody dollar costs in too much too soon, is they think that they're dollar costing in, but really they're loading up. And how do you know? How do you know if that's the case? Very simply, is I might as well give a visual here. So here we are. Here we are on an Elliott Wave on the way up, yeah. So here's the Elliott Wave on the way up. Is if you let's say you're going to go on a short and you thought this was the peak. So 3, 4, and this blow off was 5, and reasonable to think it. Okay, so you catch your entry. You catch your entry here, just to put a figure on it, yeah, at 65. So, but then it starts to go into, or even let's pull it down a little bit more, make it so, do you know what, I'm going to exaggerate it on purpose. You went in here, and then it came down, and then all of a sudden it's going back up. So your entry point is 60, let's say 60 cent. And a simple way to understand it is, if you put in the right amount of dollar costing at the start here, and it goes up here, and then it goes up here, and then it goes up here, it went up to 60.76, 60, 69, so 61, 61.12. It's not a huge amount of difference. I'm not sure whether I'd even dollar cost in here. But let's say it went up to 62 or 63. Here's 62 here, yeah. Let's say it went up to 62 here. So if your dollar cost amount is correct, the right amount, is you could put, let's say you put $100 in here, is you could put another $100 in here, okay? And if you did that, normally it pulls price act, because you've put double the amount of money in, it pulls your entry point up about 50%. Okay? So your entry point was here. Let's just mark that in green. And now is your entry point was 60. Price action's at 62. Now your entry point is 61. Okay? Generally it's about 50%. So you've now got an extra cent on your entry point, and price action is up here. But how many times can you do this? This is the point we're trying to make now, is how adaptable are you? Is if if you can do this once and then you're under pressure and you can't do it again, are you dollar costing in the right amount? If you can just do this once and then, oh no, price action is going up to 63. What's your problem? What's your problem? Now remember, we're relating it to dollar costing. So don't worry about getting your TA right or not. That's not the point of focus. It's your dollar costing. So now it went up and you're able to pull the entry point up by doubling you've now 200 in the game. Okay? But then it goes up to 63. It goes up to 64. So now it's gone up another bunch of points. If you double, so you've got 200 in, if you put 200 in now, you're at 61. The price is at 64. So if you put 400 in now, so you have 200 in, you put another 200 in, this will bring your entry point up to 61.5, probably a little less. Isn't that right? 62.5. Probably a little less. It won't be 50%. It'll be a little less. So let's say 62.25. There, 62.25. Okay. So your original entry point was 60. Price action's gone up to 64. You've now, rather than $100 in, you have $400 in, and your entry point is now 62.5. So all is good. And you still have your liquidation price up here as well. Your liquidation price is up here as well, somewhere up here, yeah? So there's two things. One is you're allowing yourself to be very adaptable with your dollar costing. That's one part of it. And then the other part is knowing the trade, knowing the price action, knowing that even if you miscalculate your entry point, you're still following price action where it's going to turn. And a simple example is Mountain Peak. Lately Mountain Peak normally with Mountain Peak, it lands between Skyline and mid-range high. So it's always within that range. Well, not always. For the majority of the time, it's in that range. Sometimes it will go all the way up to Skyline. Not very often. And it's been doing that a little bit lately. Other times it's been low. It's low. It hasn't gone up very far at all. Again, depending on the pressure that's coming down on it, or depending on the push that's going up. So there's a volatility in Mountain Peak at the moment that 90% of the time wouldn't be there. But the challenge is that at any entry point are you putting the right amount in your dollar costing at the start that allows you this adaptability? If price action goes against you, or again, your dollar cost in the same way if it goes for you. Because let's say price action goes up again and it goes up from 64 to 66. So rather than putting 400 in, because you have 100, you put in 200, now you've put in another 200, so you have 400 in. So rather than putting another 400 in, because you want to leave some for the opposite direction as well, you put another 200 in. So now is rather than getting 50% of a move on your entry point, you'll get less. So you're going to get a quarter of this generally. So you're not just 2 points away, you're plus this 1.5, you're 3.5 points away. So if you put another 200 in, it's 50% of the amount you have in. But it's 50% of this 3.5. If that makes sense. Sorry, no, tell a lie. Correct, my correction is it's not 50% of this. It's not 50% of 2. It's 50% of 3. Oh, I got it backwards here. Let me get this right now. Is you got 50% in the first one because you put 100 in. You doubled your amount. You put 200 in, so you doubled it again. It brings you up another 50% of the difference between price action. So let me make sure I'm going to talk this through. I was correct and now I'm questioning myself. So we started at 60. It went up to 63. We put in another 100. That brings us up to 61. From 60 to 62, we go up another 1. So we go up to 61. That's right. So entry point is at 61. Price action is at 62. It goes up another 2 to 64. Okay, this is where I went wrong. So it's up at 64. We put another 200 in. Okay, so now it goes up 50% of this distance. So it's from 61 to 64 it goes up another 1.5. I was right actually. So 62.50. Okay. So now price action is at 64. Let's say it goes up another 2 points. Now it's at 66. You put another 200 in, which is 50% of the amount you have in. So you generally in that position, it doesn't give you 50%. It doesn't give you 50% of this because the gap is getting bigger, and then the price action moves in smaller amounts. You always get your best move on the first 1 or 2. So my guesstimation here is if you put another 200 in here and your entry point is at 62.50, price action has gone up to 66, is you're probably going to get another 1 out of it. So you'll end up at 63.5. And I would say realistically, it'll be between that. So let's say 63.25. So now entry point is at 63.25 and price action is at 66. Okay. So I would suggest to you that when you're dollar costing in, is you need to be able to do at least $3 cost ins where you can put 100% in. So if you put 100 in, you can put another 100 in. Or if it's a $10, you put another $10 in. The second time, you double it, you put 200 in, so you meet that again. And then the third one is preferably you can meet it again or halfway. And that gives you $3 costing positions up. If you let price action go higher, you can dollar cost in later and you'll get the same effect. It'll pull you up more if you wait later. So there is that to it as well. So you want to be able to do that at least 3 times and still have money left in the bank so that you can dollar cost in more if really necessary, or if it comes down and it starts to go work your way, is you want to be able to dollar cost in as it's coming down. So you're looking to have at least 5 dollar cost touch points that you can enter into. If you use a quarter of the, let's say you want to do $1,000 in total. If you put 250 in as your starting point, you're leaving yourself very tight to dollar cost in after that. And be adaptable. It's fine if it goes your way. it's working for you. You know, it's grand. But if it's not going your way and you need to be more adaptable with moving with price action as it moves and moving your stop loss with price action, again, the example here is if it's going up, you can go with it. You want to give yourself that adaptability. So if you're putting in 1,000, is put in 100, not 250. And give yourself the space to dollar cost in. If it starts to move your way, you can dollar cost in and again build it up. So you gotta be clear about how much the total do you want to put into this trade. And then how do you break it down that you give yourself at least 5 opportunities to dollar cost in. It doesn't mean you'll always use them. So if it goes your way, is you can dollar cost in more and you don't have to take five times to do it. But if it goes in the opposite direction and you need to move with price action, is then those 5 positions make you very adaptable. So you have to think about that when you're dollar costing in, and the risk management and what it actually means, and more importantly, how much does it mean? What's your total, and how do you break that down? That you can put 100% of your first amount in, you can put 100% of your first and second amount in, and that even put 100% of your third amount in, even if you don't put it all in at once, that you can do that. Does everybody understand? Does anybody have questions on that? No questions.
Yeah, Roy. So basically, it's not like you can just put like $5 in, right, to reset the entry point as you dollar cost in. You got to put in 100% of what you put in before. Is that, or match it?
Well, the reason why I'm saying 100% is because if you put in, it gives, and especially for the first 1 or 2, you get your best result on your first 1 or 2. So and after that it's diminishing returns. So if you put in half of what you've put in, if you put in $100 or $10 and you put in a 5 or a 50, is again it will, the equation will be, if it goes up 2 points and you put 100% in, you'll get a point in your first movement. If you put 50% of your full movement in, you'll get a quarter movement. So if you can double it, you get a better position movement. Your entry point moves to a better position for you. You get a better result. So how much you put in at the beginning really does affect your ability to move your entry point after that without it costing an arm and a leg, and you using all the money that you wanted to put into that trade, using it up in 1 movement or 2 movements, and then if it's not going your way, people start to get stressed out because they're moving into the red then. So do you understand did everybody understand the difference? Yeah.
Yes, sir.
You're really controlling your risk management, and you're giving yourself that adaptability. So or if you put in too much and then you start dollar costing in, you're going to start to feel like you're digging a hole. And there's a big difference between you feeling like you're digging a hole and you moving your entry point and giving yourself more space in the trade and being comfortable about it. They're 2 very different experiences. So, and part of why people may dollar cost in more, one is because they don't want to lose the opportunity of the trade and the position, getting in a good position with a good price. But if you're getting into a good position with a good price and you build on it, if you're doing that repeatedly, if you're winning far more trades than you're losing, is after a while, how much you earn out of one trade doesn't really matter. It's that you're continually winning. And even if a trade turns the wrong way for a little while, is you're still winning in that position. And the way I'm suggesting keeps you far more adaptable. It's a much more relaxing way to trade. And everything, the wins accumulate anyway. And you get more skilled with your entry points as well. So I'm asking everybody to double check what they understand about dollar costing in, and specifically, you need to know how much money you're going to put into any given trade and then separate it accordingly to maintain your adaptability. And sure, if it's going your way, go on ahead.
Well, what's the difference then between dollar costing and loading? And also, how do you keep track of this? Do you have a spreadsheet, or every time you actually dollar cost, how do you make sure that you're on top of your average?
Yeah, well, loading is putting a lot of money in first.
Okay.
Like that's why when you're loading up, you're going in big, so to speak, or you're putting, or not big, but you're putting it all in on your first move.
Okay.
So it means that your entry point becomes very rigid. You won't be able to move it, so you can get caught in stop loss battles very easily, and you've planted your feet. You can't move your entry point.
Okay.
So and people have a tendency to be protective then, and they'll use stop losses. So that even means your stop loss, you'll keep it nice and tight. So therefore, the window you're entering in becomes quite small. So what was the other thing you were asking? No, there's no spreadsheet, because it's actually quite a simple strategy. The more familiar you get with it, you need to know what is it the maximum that you're going to put into this trade, and then you need to look at the way dollar costing works and how you get your best. You want your best moves to be your first one or two with regards moving your entry point. So if as an example, if price action moves a cent here, no, don't dollar cost in, because you're too close to your entry point. Even 2 cents, I'm using this as the metaphor as an example, even 2 cents is too close. 3 cents would probably be better, because you'll get a better move on your entry when you dollar cost in. But you gotta be able to, if it doesn't go your way, that you've got 3 or 4 goes in it at least that you can dollar cost. And that is a very good risk management. So now another thing that why might people be getting confused and thinking they're dollar costing, but they're not managing the risk of it very well, is the difference between trading a 15-minute trade and trading an hour trade or a 4-hour trade. And I'll use the 15-minute arc as an example here. Yeah, I'm just going to change the screen. There we go. Okay, so now here's the 15-minute. I'll get rid of these 2 5s out of the way. Okay, so here is, let's say we're looking again to do a a short here, and to look for hitting taking profit here or taking profit here. But let's look at mountain peak. If we're trading on the 15-minute, we're looking for a trade that we're looking to get an entry point and take profit here or take profit there. Okay, let's say on this Elliott wave is look to take profit on this Elliott wave. Okay, so that would be a 15-minute trade, so to speak, where a 4-hour, an hour, or a 4-hour trade is different, because there's going to be a breakout here. And then as it breaks down, it's going to come down, it's going to do its thing. Wherever it lands, just as an example, it comes down here. We're trading on the hour trade. We're using the 15-minute as an example. But so while you're looking for your entry point here, your take profit somewhere down here. So it's a bigger trade. It's going to go on for longer. So I think this is part of what can confuse people is how I view dollar costing in on this movement compared to this movement are two very different things. So I might look at this movement, and again, we could be back to our entry point was here. Look, it starts heading down. All of a sudden, we get this 4 shooting up to 5. You know, our liquidation could take this, but if we didn't want to, we wanted a dollar cost in. You could get a dollar cost in somewhere around here, and it'll pull your entry point up. So that's simple enough, okay? But now, if you're in a 15-minute and you're looking to enter at 60, let's say 65, and you're looking to take profit at 50, 59, it's easy to, and psychologically, think that I'll put in money here and it'll move away here, it'll retrace, and then it'll move away again. So I dollar cost in here again. Look, it comes down, it retraces back up, it heads down again. I'll dollar cost in here again. Is here, retraces, might even dollar cost in here. So entry point, 1, 2, 3. So every time a retrace happens and it moves down again, you know it's going down another leg. So this is when you dollar cost in. This is when you dollar cost in. This is when you dollar cost in. Or in truth, you're really taking profits around here. So you're looking at this and going, okay, my entry point is here. 1, $2 costs. We'll just talk about taking profit there. So now I'm going in 3 times here. So what I'll do is I'll split my money 3. I'll take a third here, a third there, and a third there. Logically, that makes sense. It's on a 15-minute trade. So it makes sense. And yeah, it'll work. No problems. But the problem arises if it starts going this way and going more than you anticipated. Like this is a perfect example. Look at this. Look at this working its way up here. So again, you can see how high this is after coming. So this could easily catch people out, you know. And you may have to dollar cost in here. Let's say somebody jumps in here on a confirmation, you know, because this is it's breaking down, confirmed, and all of a sudden it's coming back up here. You might find yourself dollar costing in to bring your entry point back up. So putting a third of your money in here leaves you very little space if it goes in the opposite direction. Well, if you put the same amount in again, and you got one movement out of it, is you can't put the same amount, you can't put 100% in again, because you're already 2/3 of your money in the trade. So you get caught trading on the 15-minute if you just split your money 3 ways. If it goes this way, you're going to feel yourself under pressure. Does everybody understand? Where is, I would suggest people start trading this way. Is it going to break out, break up, or break down? Let's assume it's breaking down. Okay, not even assume. TA tells us it's breaking down. you put you get in here, even if you have to go up a little bit, you get your entry point here, okay? You let it do its thing. It's going to come down. Second drop, third drop. You know, it'll come back up for another peak. And as it starts to move down again, here's a natural point. Here's a natural point for you to dollar cost in again. Now, you haven't broken out of the arc, but look, it's dropping down. There might be a final retrace and then down it goes. This one's particularly big. But even if you dollar cost it in here, your entry point gets pulled down a little bit. You're nowhere near the battle zone. And this turns and it goes down and it breaks out. Here's another dollar cost. When you get confirmation of the breakout, you might even wait until you get confirmation of the breakout, and then you dollar cost down on the breakout here. And you're going to get the drop, it'll retrace, dollar cost in again. So dollar cost here, dollar cost there. It comes down, it starts to do the mid-range high, comes up a little peak, and then it drops down again. Again, you dollar cost in here. So by the time you're coming down to third spike, this is where you're looking to take profit. And you have lots of opportunities along here to dollar cost in. And to be honest, once I see this here, I put quite a decent amount in here, because now I've got the confirmation breaking out. I put a decent amount in here. It'll pull my entry point down a bit, but I'm still in this arc. Now price action is firmly moving into this arc. So I'll put a decent amount in here, and then I'll add a little bit more, and I'll add a little bit more, and off it goes. So a little bit here, a little bit here, a little bit here, but this is the one where I'll put a decent chunk in. So that price action is still here, is still high enough that my entry point will come down a little bit, but I won't come out of this arc, and price action has confirmed itself for on the way down here. So that's a really good way to do it. So if you look at Mountain Peak, rather than the short trade, as in time wise for third drop, think about trading all the way to third spike. Okay, it allows you to be more comfortable putting in a smaller amount on your Mountain Peak here. Yes, it will be a longer trade, but the percentages will be far greater. And the pressure's off. Once you've got your position, and it's a low position, even if this turnaround went up this way, when it just did something absolutely off the chart, went right up that way, even if it broke up here, went up here, and shot up, you've only got a small amount in entry point here. Like, your risk is really low because you haven't loaded in yet. So even if this went the opposite direction, you're still in a very good risk management position. So this is what I'm trying to share with you tonight, yeah, is how much you're loading in. Equally, let's say this is going to break out. We think, the bull trend has come in, it's turned. We're getting our signals for up, and we think it's going to break up. Well, there's two positions you can go for here. Is third drop or final bounce. Pick one of them. Third drop didn't come very low here, but third drop can be quite handy when it comes lower, because generally this is this is on average now, third drop is lower than final bounce. So that you've got third spike, first drop, third drop, in the middle of the arc, this is the lowest point. So when you get a nice sweet entry point here, again, it has price action here, it'll do a little bounce down, and then it will bounce up. This is a really sweet trade to get in all the way up to skyline here, all the way up to the peak here. And you can do the same thing. Is you're catching the trade. If it goes down further than you think, again, you can dollar cost, pull your entry point down, turns around, it starts moving up. Is again, if you're going for final peak, is you're gonna move fast with your dollar costing, and you're most likely going to put in too much at the start, which is fine if it goes your way, but if it goes against you, is you're going to be putting yourself under pressure much faster. So here, let it do its thing, let it break out, and again, once you've got the confirmation of the breakout, now you dollar cost in. It'll pull you up a little bit, but you're still in this arc, and it's playing out here. And then, again, as it goes up, you're going to get the same thing. It's going to be 3 steps up. There's the breakout. Oh. The breakout, the retrace, the breakout, the bigger retrace, and then the final breakout. And then you've got your 3 steps down. So again, here's your dollar cost opportunity. Retrace, dollar cost in again, retrace, dollar cost in again. So anytime there's a retrace and it properly shows itself moving away, is always a dollar costing opportunity. So that is a very effective way to trade the trade. It's longer than doing the smaller. It's longer than doing the smaller trade, like the trade from first drop to mountain peak. It's a longer trade than that. So you can get this sweet trade here, third spike. You can get another sweet trade all the way from third spike to mountain peak. But mountain peak to final bounce is there's less volume. And especially where we are now, volumes are very low. Is wait until you see the size of these arcs when volume comes in. It'll pick up. These trades will be juicier, but at the moment is these trades are I think catching people out where they're dollar costing in too soon or too much too soon. So, and even if these trades become a better volume, I still think the better trade long term is, and the safer trade is, get a sweet spot here. Know your TA is going down. Get a sweet spot here all the way down to third spike. Is if you know it's going up, either catch it at third drop or final bounce, get in there and then let it go all the way up. And yes, you're longer in the trade, but you've got far more percentage you're making. So you're actually making far more profit on this one than you would be jumping in and out. And it's less stressful. It's less stressful once you get your position. So that's why you gotta look at how much you're gonna put in, and then from there is, now if I need to dollar cost this 4 or 5 stages and do decent movements in my entry point, is I want to be able to double the first 2 at least, and 50% another 2 after that. Has anybody any questions?
Hey Roy, what do you start when you initially start? What do you put in? Like, what percentage do you start when you do dollar costing?
To be honest, the one I'm talking about, I look for 5. I look to be able to dollar cost in 5 times.
Okay, I know the times that you do it, but when you first start out, what do you start out with? Like, how much?
I don't understand your question. I hear what you're saying, but
okay, like you know, I guess some people start off with 0.01. I'm just trying to figure out, you know, if you're doing dollar costing or longs, what do you start out with? Like, how much?
Well, let me ask you a question. How much is the amount you're going to put in the trade? How much do you want to put into this trade in total?
Okay, let's just say you started out with 1,000. Let's just say that.
Well, no. I'm asking you a more specific question. It's not what you're starting out with. It's how much do you want to put into this trade in total. So you're not starting
Okay.
out.
All right, let's use an example. Let's just say 10,000.
Okay, so now that's your limit. So you know that. Does that make sense? So
Yes.
if it's 10,000, do the math on it. If you put in 1,000 as your entry point and you need to double it, can you do it? Yes, you can. So you've 2,000 in. Can I double it again? Yes, you can. You've 4,000 in. Can I put 50% in again? Yes, that's 600. Putting in another 50% is another 300 because you have 600 in it. 50% of 600 is 300. Yes, you can. So if you dollar cost in 4 times there, it takes you to $9,000, and you can put in another $1,000. But again, you're just adding. You're adding to your load there. You're not going to get much of a. If you're using that $1,000 to move your entry point back, you're not going to get much of a result. So that last 1,000 you'd be putting in when price action is going in the right direction. You understand?
Got it. Thank you. I just wanted, I thought maybe you had percentages, but I see what you're saying. Okay.
Yeah, and now whether that's $100 or $10,000, it's still the same equation. It's still the same figures. And the reason why 100% is because that moves your price action. You get the best result in your moving your entry point. That's why you're doing it. If you only put in 50% of what you've put in, you don't get such a good movement on your entry point. And the first 1 or 2 moves, especially the first one, you get your best result on moving your entry point. It's diminishing returns after that. So you could put in 100%, you get a great return. 100% the second time, it'll be a very good return, but not as good as the first one. You put a third one in, 100%, and you won't get the same good price, the entry movement. It's diminishing returns. So it's good that your first 1 or 2 movements are 100% of what the amount of money you have in. So if you've put in a lot of money at the start, that game gets too hot for you too fast. You've put all your money in very fast, and you're like, Jesus, now I've moved my entry point a little bit, but if the price action keeps moving, you start to sweat, you start to question yourself, you start to get anxious. It plays with you. So, and you want to be confident about your TA. This is part of it as well. So confluence plays a big part in it. You need to know that it's going to turn. And even if it's going up far higher than you anticipated, it's still mountain peak. If you know in your heart and soul that it's mountain peak and you've misjudged how high it is it's still mountain peak. It is still going to come down and come to third drop. So if you know that, you have to remember that and not let the stress of it, the stress game, just trigger you and make you come out of a trade when you don't need to come out of a trade. Which happens for a while. And afterwards you'll be like, geez, I didn't need to come out of that. But that's just part of the learning experience. But if you know it is mountain peak, is you need to remember that when you're doing this. You need to hold firm in your own mind with that. You can't be second guessing yourself all the time and throwing out 101 possibilities. It's not. It's either up or down, and it's either mountain peak or it's not mountain peak. Does everybody understand? It's absolutely an Elliott wave, and that Elliott wave will peak and it will retrace. So where exactly on that Elliott wave is it? So confluence is a big part of this, because confluence gives you confidence to go in on that. And then you just got to practice it. So there is a discipline to not loading up in your first entry. And think about you're moving in to gain position. The position you start at isn't necessarily the position you end up at by the time the trade is fully going. So you have to think, I'm moving into a position now where I want to stay as adaptable as I can be at the beginning of every trade. As the norm, it's your normal way, it's your normal approach. Now, if you want to start putting more money in, is you still take the same approach. If it's with $100, you break it down to $10, $10. You know, you go, yeah, but Roy, I want to put more in. Okay, well then, if you're going to put more in, you still go, well, rather than putting 100 in, Roy, I want to put 200 in. It's not, I want to put 100 in, but I want to put more in at the start. Don't think like that.
I shouldn't have, Roy. I shouldn't have used the figure of 10,000. I should have just used the figure of 1,000 or even 100 would be better.
But I would Trailer. I'd give you the same answer. It's the same equation.
Yeah, I know. I'm just telling for the newbies.
Okay.
Forget that figure of 10,000.
Yeah.
Focus on the 100.
Focus on the 100. Yeah, exactly. Yeah. So, and if it's 50, well, then it's 5 and 5 and 5 and 5. Same. Is you got to think about again the amount of times that you can dollar cost in and it be effective. It's not just I'm dollar costing in and you're going through the motions. You're doing it to move price action. You're doing it to create a more space for your stop loss or your liquidation for price action to move into. So it has to be your dollar costing has to be effective in either direction, and you got to control the greed element of it, because the only reason we're loading into the start is because we want to maximize our profit. And I'm telling you is that if you do the strategy the way I'm telling you, you will have more wins than losses. And the more wins you have, it's that continual accumulation. It's your continually collecting profit. After a while, doesn't matter how much you're making if you're continually collecting it. If you want a better result, rather than having $100 and going, okay, now I'm going to load up more, but still only use 100, is, well, if you're winning and your money's going up and you go, look, I was using 100, starting with 10 and loading in 10 and 10, is, look, I'm after having a few good wins here, is I'm going to use some of this, and now I'm going to put my trading amount up to 150 or 200. Okay, so now if you're going in on 200, now your first dollar cost in is not 10, it's 20. But you can still double and double. You can still follow the same strategy. It's just the amounts you're using are moving up with the total amount you're putting in. So now your profit is growing. You're still following the same strategy. So it doesn't have to be, oh, listen, I'm putting a very little in here, then it goes my way, and then like I'm trying to rush to get my money in the trade. It doesn't have to be that way. Does everybody understand? And confluence. If you know it's mountain peak and you know it's going to turn, is stay calm. There's no need to be working yourself up. I'm not saying don't get stressed about it. Of course we can be challenged with it at times, but you need to remember this is mountain peak. So feeding your stress on this is not helping. It's not going to do you any good. If you want to do something, is do your TA. Test your TA more. So, yeah.
Dollar cost in, and you were thinking at the final.
You're very,
like just before the final retrace.
you're very low. Can you speak up a little bit, please?
You hear me better now?
A little bit, yeah. Hello.
Better now?
Yeah, much better. Go for it.
Question is, let's say a dollar cost in at the final, expecting that this was the breakout.
Yeah.
For example.
Yeah.
And then to what it currently is.
Yeah.
And make another arc. At that point is
you broke up there. Say again.
Keep them up and in.
Say again.
You broke another arc. You broke outside. You broke up instead of breaking down.
Yeah.
To the next, like the way you're drafting it.
Yeah.
Right now.
Yeah. Sometimes. So now, are you saying as a fake out before it goes down or it goes up?
Could be like you at the beginning. You would think it's a fake out, but later on, it's making the arc. It's going into the 3 steps.
Yeah, it's going. You mean it's breaking up? It's going up.
Yeah.
Yeah. What again?
At that time, so that I gain the position.
Say again.
Out at that time. I was thinking it's down, and then it turned it around, made another arc to go up.
Yeah.
Should I be dollar costing out at that time, or just keep it and let it ride out? Even if liquidation is way up too high.
I'm trying to understand, because I think your sound is coming in and out. I'm not fully hearing. Let me see if I can repeat and see what you're saying. Is you're looking to go on a long to go up, isn't that right?
Short.
Okay, so you're looking for a short, and you're then saying it turns around and it goes up. Is that right?
Had a dollar cost in. You went short at Mountain Peak. You added your position at the final bounce, expecting that was the breakdown. It turned it and it made the retrace.
Okay.
And break out of the arc and creating another arc.
Yeah. You're talking about
it fake out.
So sorry, but you're saying it's going up now. So
the 3 steps are forming.
But hang on a sec, because I need to understand very clearly. Are you saying that rather than it breaking down like anticipated, it breaks up? It's going up. It's not a retrace. It's a break up. It's a breakout to the upside. Is that what you're saying?
Time frame, for example.
Say again?
Yes, you're looking at that taken out of the 15-minute arc, but it's still 1 hour arc.
No, you have to answer the question I'm asking, because I can't follow you until I understand what you mean. And you're suggesting that we're going on a short down, and okay, it does a thing where it comes down to a bounce, but then it turns around and starts breaking up. So are you suggesting it's a fake out, or are you saying what do you do if it turns into a break up? You need to answer that question so I can understand what you're saying. Is that what you're saying? It's breaking up?
Yes.
Okay. Yeah. Well, okay. Well, then what you would do there is if it's breaking up, is you gotta look to see the pattern of it, and as you said yourself, is if it starts to do the 3 stages, and there's a breakout and it starts to do the 3 stages, at some point you have to decide that is this a fake out or is this a breakout to the upside? And if it is a break up, is you need to then come out of the trade. You
out,
understand?
or just take your dollar cost out, because it might be breaking out, and then the next arc will be bringing it down. It's just like
Yeah.
it's breaking
Listen,
15-minute arc, but staying within the hour.
yeah, I've done that where I've been in trades here and it comes down, and and this is previous is I was thinking it's breaking down, it goes up. I've stayed in all the way to let it do its thing, and I've dollar costed up. So my entry point's around here, and I'm waiting for it to come back down, and then I'll stay in and I'll either take my profit here, because mentally I was busted, or if I think it's going to go down, I'll stay in. Yeah, you could absolutely do that. The challenge with that is that you're getting drawn into staying in the red for an extended period of time, and it will still turn and come your way, but you got to be willing to be patient with that, or take your loss, or take a portion of your loss, or if you think, look, this is turning and it doesn't look good, is you come out. You come out if it starts hitting your entry point. So now it's turning up and it's heading up. Is if it's hitting your entry point and doesn't look too good for you, is come out. Do you understand?
Thank you.
Yeah, but did you? Very good. But did I answer your question?
Yeah, you did. Like, it's just like I wasn't too sure whether should I be pulling out myself completely, or should I be taking whatever I dollar cost in.
Yeah.
Like it's just a debate like that I'm debating myself.
Yeah.
Like,
yeah.
Okay, so
Yeah, totally. I get you. Well, for me, like in this situation, let's say this one as an example. Yeah, is
yeah.
I posted there that the hour is hidden divergence. This is getting exhausted. So this here is going to drop soon. Yeah, but let's say it didn't. Is what I'm looking at here is that if it starts getting above final peak, it's a little alarm bell for me. But again, price there's absolutely no problem price action coming up past final peak here before coming down again. But it's an alarm bell. It's I'm watching it, So let's say my entry point's around here, and then I start to see it coming up, and heading for Mountain Peak. Now Mountain Peak's pretty low here, but let's say it's heading up for Mountain Peak. I'd be getting super cautious about, okay, how far is this going to go? So if it started going much into Mountain Peak, and I'd be watching the way it's behaving, I might think I'll come out of that trade. I might break even, or I might take a little bit of a loss. Or again, depending on it, I might go, no, I'm staying in for this, and we'll see where it goes. But I would do that if I knew I had lots of space to dollar cost in. I wouldn't do it if I didn't think I could dollar cost all the way up to where I thought it might go. And I wait, let it do its thing, and I give it time, and if price action's up here and I dollar cost in, it pulls my entry point up. So I can get my entry point up quite high and let this play out, come down, and then I'm back in again. I've done that before. So it just depends on it. It depends on, again, it's back to how much adaptability have you got on your entry point. If you've got the space to play, I tend to like to play the space. If you don't have it, if it's breaking out and you're like, look, I can't dollar cost in past this point, and this looks like it's breaking out, get the hell out of that trade. That's the problem. If you can't dollar cost in anymore, and all you're going to be doing is going up into your stop loss and going into your liquidation price, is get out. If you've got space to play, is maybe go, I'm going to play this space. So it really depends on whether you can play this space or not. So, and that's the skill of dollar costing in the right amount at the start. So less is more at the start, because you want position, and the position you start at isn't necessarily going to be the position you end up at by the time the trade is fully in and going. And knowing that from the beginning, is your entry point isn't always going to be where you end up by the time this trade gets going. If you go in with that mindset and having the ability to move it as much as you can, it's a very good risk management. But also confluence is a big thing, is knowing the movement. So again, if you're going in on the breakout here, you know it's going to come all the way down here. You know, so you've got a long run here. So even if you went in final bounce, well, there's final peak, there's final bounce, here's a retrace, is you go in here. Don't wait for confirmation there. Is because waiting for confirmation, this is where people get caught. Is if you know it's going down, is look, final bounce, here's the final retrace. This is where you want to go in, and then you're dollar costing down. So you're trading positions, not confirmations. So if you're going up, if I'm going to go on a long here, is I'm going in at third drop or final bounce. I'm not going in when I've got confirmation here, which is what most people do. Why do they do that? Because they don't understand confluence and they don't have confluence. So they have to wait for confirmation. But if you understand confluence and you see that this is going up, well then why do you need to wait for confirmation? Why wouldn't you go in on the best position that you got? Well, what is that? Well, one of the one of the bottoms. There, go in there if it's going up. So that when all the drama of the breakouts going on here and there might be fake outs, is you're already away from it. And then you've got your ability to dollar cost, and you got your space in between. So you've got all this space that you can play and still be safely in the game. Rather than going in here on confirmation, and again, if you start getting tricky plays going on here in retraces, here's your play, your space of play, and you're in the red and you're in the battle of it. You're less likely to get in the red than the battle of it here. And if it does get into a bit of a battle, look at how much space you have compared to getting your confirmation here. So this is position trading. This is confirmation trading. No confluence. Because if you had confluence, why would you wait for a confirmation? Get position. That's the difference. So confluence is...
Well, what if you get in on final bounce and it starts to go up and up and up?
You're talking about final bounce and here, but you're going in and along. You want it to go up, no?
No, I'm saying if you don't know if it's going to go up or down.
Well, you see, there you go. That's the skill of the trade. Is this is what I'm showing you with the arcs and the arcs on the different timelines. Is this gives you confluence. So more often than not, 9 times out of 10 is I know the direction it's going because I've got confluence. That's the power of confluence, trailer.
Can we plug into your brain by chance?
Yeah, well, I'm showing you the trick. There's no doubt about it. It is one of the more challenging. Confluence is one of the more challenging aspects to get your head around, because you have to get used to looking at all the different, mapping out all the different timelines, and being able to put them together. And that's tricky because. This is why I say start on the 15-minute, because look, it's giving you price action. Even the 5-minute is giving you lots of price action. You know, you're mapping it. It's busy. It's engaging. You know, you're learning fast. So you're learning all the skills fast. It's great for that. But it has its own limitation. With regards when you want to trade either bigger timelines, or let's say you don't want to trade. Roy, I don't want to trade bigger timelines. I'm very happy to trade the 5 and the 15. I'll do it forever. I'm absolutely great with that. I don't need the hour. I don't need the 4 hour. I don't need any of those. You do. And what you need them for is confluence. So that when you come to your 15 minute, you want to know it's breaking down or breaking up before it happens. So how do you do that? Well, you need to be able to map out the red one, your hour. You need to be able to map out your 4 hour. You know, even your daily here and your weekly is map them out so that you know that this is mountain peak on the 4 hour. It's also skyline on the daily. So you know price action has a journey to go down here. So you know all the 15 minutes that are happening for the next while are breaking down. What's going to happen after this one? It's going down. What's going to happen after this one? It's going down. What's going to happen after this one? It's going down. How far it's going to go down? Not really sure. Could we get it wrong? Because we're coming to the bottom and we're at the bottom of a big bear channel, and it's we're coming to the very end and it's getting close. Yeah, this is tricky. This is tricky trading here. There's a lot of people stepping back and not trading this because one, they have a tendency not to trade the bear so well, and two is they find it very difficult to read this because they're just used to reading the smaller time frames. You have to be able to expand out to see how the hour is behaving, the 4 hour, the daily, is looking at those later MAs, the dailies and the weeklies, and you can see the pressures that are being applied. So you need the hour, you need the 4 hour to be a better trader on the 5 and the 15 because it gives you confluence. And then you can have confidence in the confluence. You don't need to wait for the breakout. Sure, I'll just go in at Mountain Peak and I'll ride this puppy all the way down. Or I'll wait for final bounce, it'll be final retrace. I'll hop in here. I won't wait for confirmation because I know it's going down. Do you understand?
Well put. Well put.
Yeah, but again, it's like you guys, for the amount of time that you guys are in it, is the conversations we're having now are quite refined. Is the fact that you can even understand what I'm saying and make sense of it, it's a big deal. Is I don't expect you guys to be able to map out the hours and the 4 hours and start to put them together immediately. It just takes time, and you got to break out of just following the 15 minutes, which again it's a mental discipline to be able to hold these greater time frames and the smaller ones at the same time. There's a skill in it. There's a discipline to it. But the value of it is enormous. I can't tell you how valuable it is when it comes to your trading. And then how comfortable you get with position trading. Don't wait for confirmation. Trade on position. You're in it. Okay, even if you got to do a little battle here, by the time it's off and running, you're sitting back and you're just watching the show. All these pushes and pulls here, all the drama here, even if there's fake outs here, they're just opportunities for you to load in, to put a bit of dollar costing in, because you've already got position. Much calmer way to trade. And then you'll sit in and you'll be patient for this to play out because you're already in the dollars. You're already in the dollars. So you're just seeing the dollars just get bigger and bigger. Your problem is knowing when to come out. So yeah. So
I got a question for you.
Yeah, go for it, yeah.
Yeah, I was thinking about it, and I think at least my main kind of difficulty to overcome is identifying the arc steps properly. I was wondering, would it be beneficial to have some sort of a test or something that you and the coaches maybe could put together to where kind of you throw it out to us and say, hey, identify mid-range high or whatnot. I through the different steps too, because obviously a downtrend, uptrend, you know, the troughs and valleys all present different kind of challenges in identifying that arc.
Yeah, I'll be honest with you. I do find it challenging at times as well, regularly. Is in hindsight, it's always really easy to map out an arc. Like in hindsight, it's easy to map all these out in hindsight, so to speak. This is why
That's actually good to hear.
Yeah,
we're not alone on that. That is difficult.
They are, yeah, they are. Like, and this one here now is it was tricky because it's a low volume. There's a nice big drop in this, and then there's a low volume. This is a low mountain peak. Like, look, this is mid-range high. Mountain peak is just at it. Like here's resistance peak is even low. Normally, is you got resistance peak, mid-range high, and in between you've got mountain peak. So it was a challenge to figure out which one is it, and then look, is it going this high? How high is it going? So it absolutely is a challenge at times. But again, what you need to know is that this is an Elliott wave. Now the question is, while you're looking at this on the 15-minute, what timeline gives you the best detail? So often, if I'm looking at an hour, if I'm looking at a 4-hour, I'll go to a lower time frame. So if I'm in the 15 and I don't see the detail, I'll go into the 5-minute. Because the 5-minute lets me see more candle detail. It lets me read the nuances. So when you're trying to figure that out, there, I've turned that upside down, you know. So you're reading the Elliott waves, and then equally you're using your fibs. And again, I'm not going to get into that now because I'll end up mapping out fibs, but you can use previous price action to get a measure of where the next price action is going to go. So I think what we'll do, I think maybe I'll do another one of those. What I'll do this week on Wednesday, I'll do another. I'll do a reading of the arcs, mapping them out, and then I'm going to bring the fibs in and go look how the fibs can help you map it out. Does that make sense? I'll do that. I'll do that because that's a whole. What you're asking me is a whole conversation in itself. And then.
Sure. Yeah. Definitely.
Yeah. For sure. Yeah. Because I can feel myself wanting to have that conversation and then just going, no, right. That's because that's a whole. You need to just have that as a full conversation. It is, I think, a good thing to do. And one of the ways I learned fast is I back tested. Do you remember I asked you to go and map out the arcs, the 15-minute, the hour, the 4-hour, do a load of back tests? I think it will be really valuable for you to go and back test again, map out the arc, put the triangle in, and then go and map out skyline, resistance peak, first spike, mid-range high. Go and map them all out and get very familiar with your eye of what way they behave. Like mid-range high is it plays a more fuller micro arc, and there's always a lift in it. It's always like always looks like an ascending wedge. So you always get this final push up before you get the drop, a little retrace and then drop again. So this is very, very often, this is what mid-range high looks like. So I think if you back tested them, you'd start to recognize the Elliott waves, and then also the different stages are directly linked. This one here, again, there's always a big retrace. It dips down, and it works its way up, and then again you have double top. So you got a double top. Always at the top of double top, you get a drop. It's not third drop or first drop. You get a drop. Then you always get this, but sometimes it's really high. I've seen them up here. You always get this this up here and you go, oh, where's this going? And then you get this turn, it just swan dives all the way down the first drop. Like, these patterns are repeating themselves over and over and over. So I think if you there's no shortcut to it. Here's all the names, but you got to go and let your mind mapping, get used to mapping them out and recognizing them. So there's no shortcut to that. So to speak. Has anybody else any questions? Any thoughts on what I'm saying? Okay, so whether you're trading on the 15-minute or you're trading higher, I think you should begin to follow the same strategy with regards your entry point, how much you put in, and give yourself that space. In every trade, give yourself the adaptability in every trade. It's just to think about it as like a baseline principle. I do this in every trade and I give myself that space. And when you start to tell yourself, yeah, but look, you're giving away profit there. No, you're not. You're getting position and you're getting into the trade and then you're winning the trade and then you're repeating that over and over and over. So it's allowing you to get position to win that trade rather than getting knocked out and then it going the way you knew it was going to go anyway. You get stop lossed out and then it goes your way anyway. That's just head wrecking. So you're getting knocked out of trades you don't need to get knocked out of. You're getting stressed out in trades that you don't need to be getting stressed out in. And there's real value in not getting stressed and getting into the trade in a good position and not getting knocked out. They are two valuable things to avoid. Getting knocked out and getting stressed out. So now you can see that there's a real reward in that because you can relax into it. Okay? So I think that's one thing I'd like you all to start really honing in on with your trades and practice it. And then the other thing is confluence. Is let's put a push on over the next few weeks and months to really start to get our head around confluence. So if you're used to mapping out the 5-minute and the 15-minute, but you're not really putting a huge amount of time and energy into the hour, is you need to go, I'm going to crack the hour. I'm going to start mapping out the hours, and I'm going to figure out how to map out an hour arc, and that's going to take a longer period of time. It's going to take a longer period of time because look here. Here's my. I'll put this in here now. Or actually, I'll put this in here. And this is the challenge. Here's my. I gotta change this this way. So I'm mapping out my 5s and my 15s. Look, day to day. Look, I'm engaged. It's easy. Now I gotta map out this hour. Oh, this is running over a much longer period of time. You got to hold that in your mind. You got to follow this over that period of time. It takes a focus. It takes a discipline to keep coming back to that and mapping the stages out and putting the arcs in and going, oh, there's my, and testing it and making sure you've got your hour right. So this started at this breakout on the bottom here, but the breakout here was 20th of December. And the breakout here at the other end is the 20th of January. It's the month. So you got your hour arc that could be going on from anything from 2 or 3 weeks to 4 or 5 weeks. And you gotta keep that in your focus and keep adding it into the equation, looking for your confluence on it. So you can see that the hour doesn't happen overnight with regards you following it and mapping it out, and it'll take a few goes. So okay, so there's one for a month, but it might take your third one before you're like, okay, I'm starting to get my head around this. So there's 3 months where you're looking at the hour arcs, mapping them out, and just familiarizing yourself and getting used to them. So does everybody understand the commitment in that to the focus of it? Yeah, Roy, but you know, that's a lot of focus. Why? What's the value in that? Why would I do that? Because of confluence. I can't tell you how much confluence is financially worth to you, because once you have it, there's no limit to the value that it can bring you. It can keep you successfully in trades after trade after trade after trade. There's very few times you'll get caught when you're really good at confluence. Put a price on that. There is a price, and it's your focus and your time to commit to going up the different timelines. Even if you stay on the 15-minute and you trade that, you want the confluence of the hour and the 4 hour so that you become an excellent trader on the 15 minutes. You know it's going up, you know it's going down, and you can trade that. Okay? So, dollar costing in, really have a sit down and think about it and play the long game. Think about the long game when you're doing this. It's not just this trade and trying to win this trade. It's years and years and years of trading, and it's hundreds of trades, and you're averaging out your risk management so that you can keep having win after win after win after win. And it's the compounding of that, it becomes massive. So the little bit that you feel you're missing out on because you're putting a small amount in at the start is that the compounding of your wins greatly outgrows any potential loss of profit that you think you're making at the start. I could have made more on that. There's no comparison. Am I seeing this going up again? Is this going up? Is this taking another lift up? It is taking another lift up. What's going on here? So maybe we'll have a little look at the moving averages on this while we're here. But has anybody any questions before I move off this point? Okay, so I'm hoping it makes you feel better about your dollar costing and gets you focused on it. And then your hours is start following the hour arcs. And again, think about it over weeks and months that you're doing this. So it's not something that you have to get straight away. But you're making inroads into it. And by the time you've got the hour, it's much easier to get the 4 hour after that and the daily. Believe it or not, the hour is, when you get the hour, the 4 hour is much easier. And again, the daily is much easier because you've got used to reading an arc over a longer period of time. So reading it over a few days or a week is one thing, but reading it over a month is, once you get used to reading it over a month, reading one over 2 or 3 months is not as difficult. So there's a certain timeline when you go over. The space you're able to hold it in is already established. So that's what you're looking for. Okay, so let's have a quick look at moving averages here. Why is this going up? I have my okay. You see, this always sober. This sobers me up. When you see those little prices going up, and you're going, what's going on there? I'll get these out of the way. So this one here, yeah. Here's price action here. There's the height, and there's the price action RSI, yeah? Okay, so look, you can see price action has come down, you can see it's coming down, spikes.
We're looking at a different screen. We're still at the
my apologies, I forgot.
North.
I was doing that with Alex today, you know. just change topics and okay, there it is there. There we go. Okay. So yeah, so here's price action price here. Here's the RSI here, yeah. So price action comes down, RSI comes down, comes back up, comes down again, RSI comes down a little further than it did last time, yeah. But it didn't come down, look, it didn't come down as far this time. Comes back up, comes back down, comes back up, doesn't come down as far, price action doesn't come down as far. Okay, fine. So now we're following it up. So now look at this. Price action comes up to here. Now look, here is price action here. Look at where the height of this here, yeah? And price action here. So now look at where the RSI is here. Okay. Now look, when we go across to here, because this price action RSI is linked here, look how high the RSI is after coming. So look, it was here and it's after going higher. But now look, price action is here. Goes all the way down. When it comes back up here, look how low price action is compared to here. This price action is lower. But look, here's the RSI here. And then price action is lower, but the RSI here is higher. So what's happening is the RSI is racing up, but price action is not racing up. So the price action is getting tired, where the RSI is pushing, but not getting a result. So it's a bit like pushing a heavy stone up a hill. Is lots of effort, but you're not really getting very far. So price action is getting tired. RSI goes into the overbought, and the only direction it's going to go is down. So now look, RSI starts coming down here. Look, it peaks. Actually, it peaked here. This is how you also know an Elliott wave is. I'll actually make this a little bit bigger. Yeah, is do you see price action here? Look at the height. Look at the RSI. So when you see a drop like this, okay, when you see a drop like this, and when price action goes higher here, but yet the RSI is lower, that's a good way to recognize 3, 4, 5. Is the top of an Elliott wave. Is the RSI is exhausted and drops and doesn't come back up, but yet price action spikes. You get that an awful lot of the time in 3, 4, 5 of an Elliott wave. Is you see the drop like this. So when price action is going higher, the RSI can't match it. So it's getting exhausted. So you know it's going to turn. So look, it turns. It's coming down. Looks coming down. It's dropping. And again, this is fairly reasonable. Look at the height, the price here, and it drops down a little bit. But now look at the price here, the RSI, and it drops down into the oversold here. Now look at the distance on this here, and look at the distance on this here. It's not a huge amount. It's fair enough. There's no. It's a little bit deeper, but nothing that you could really go, oh look, there's a real standout. Look at that there. Look at that figure there. Okay. But now watch this. Now this is where it gets interesting again. Look, price action is coming up. Okay. Price action, or RSI is coming up. Now look at the peak here of price action. Remember, this was the peak of this here. Is this peak here was lower. This peak is higher, and it's here. So price action is getting tired. RSI is racing up. Comes down. Now price action comes down. Now price action starts to go up, but RSI races up. But look now. This is the overbought. Yeah. So now RSI is going even higher. So now look at this. RSI is even higher than this here. Higher again. But look, price action hasn't even met the yellow line yet. As much as this is coming in, I know this is coming in here, and this is racing up, but look how high the RSI is in the overbought. And so now this is lower than this, and this is higher than that, which means at some point this is going to turn and it's going to come down. Okay, now Matt made a good point the other day, is that sometimes this is an indication of a bearish, because the RSI keeps pushing until price action kicks in. And there's an argument to that. Is a fair point. However, I think this is slightly different, where when the RSI races up so much and goes into the overbought, it's in the overbought, it's going to turn and it's going to pull it all the way down. So now look at this. It went into the overbought here, and it pulled price action down lower here. So I would expect that when this turns again and pulls it down, this is going to turn and it's going to come down lower again. So I think this movement here is going to break price action, where price action is going to start to come down and probably fall. So, and again, this is an Elliott wave in itself. 1, 2 is 3, 4, and we're having a big blow off top here. Okay. Although it is different, look at the difference in it here. You see the 3, 4, 5, 3, 4, 5, where this one here is 3, 4, and rather than the RSI coming down, is the RSI is going up and price action is going up. So that they're different. They're different here for sure, yeah. But still, the point is still the same. Is look how much in the overbought or oversold the RSI is here, yeah. So has anybody any questions? No questions? Okay, let's have a look at what's going on here a little bit, yeah. Let's go into the MAs, moving averages. Okay, let me just clear these out, yeah. And again, you can see it here in the 5 minute. Is the 5 minute there is super in the overbought there, yeah. The 15 is the same. It's been doing it for a while. Now this is where I was sort of saying earlier on, is look at the RSI level here. Now look at the price action here. So now look, the RSI is getting lower, but look, the price action is going higher. So while price action, and this is a clear divergence, is where the RSI is going down, yeah. So now you get this blast up here. So now look how much it's moved. Look at the gap in price action here. But now look at the RSI. The RSI is still only after coming up and matching this. So now look at price action here. The RSI is here and it's matching. So even though this is after shooting up, the RSI hasn't shot up with it and matching it on the 15, which again is basically saying that this is a blow off top, and the RSI again looks like it's getting exhausted here. So we'll see. Now, one of the things I was talking about earlier on is if it starts coming up, and this is final peak here. So you can see how it's coming close to final peak. And also there's this resistance line here. You can see there's a retrace already going on here. So I'd say if we went back to the 5 minute, there's the 5 minute there, yeah. So now the thought along the very good. Okay, so look at this. It is 11:39. Okay, so 11:39. So we got to look at this here now, and the question is that if this is the blow off top, and you have a 5 minute and a 5 minute, we've got 20 minutes, including this one, four more 5 minute candles. If this gives us a nice clear impression of a peak and it's starting to retrace, it's a good signal for the VWAP, so that the VWAP can come up, and then the VWAP comes up and becomes resistance. So if the VWAP's going to come all the way up here, wherever price action is in 20 minutes time, the VWAP's going to come up. If we are actually in a correction here, the VWAP will become resistance. Now, we are in an Elliott wave, and that looks like a blow off top for sure. So now we're in the correction, VWAP will come up and be resistance. Now, let's say this didn't happen. Sometimes what happens is that if the blow off top doesn't happen and we're here, the VWAP will come up, and then the VWAP will push it up, and the VWAP will be the blow off top. So you get the VWAP being the blow off top, and then it turns and it becomes resistance. You get that also. But now, because this looks like it's already the blow off top, is the VWAP will come in and be resistance here. And again, it might take an hour or two after 12 o'clock my time for it to properly get the turn. So I would say that is the case. So there's that resistance line. Let's go into the 2 hour. Okay, it's hitting the Bollinger Band. It's after breaking through the 144 there. And remember, for this to be a breakdown, there has to be this type of volatility, because there's not many more breakdowns that are left in this channel. This most likely is probably going to be the last 15-minute arc. There might be one more after it, but I think this might be the last one. And there's a volatility that will come with that. But in context, it's not very volatile. But it's still pushing a bit, you know. There it is on the Bollinger on the 3 hour. The 100 and the 144 look in a very good position for rejection here. Once it hits the top of the Bollinger here, it'll have a tendency to go to the bottom of the Bollinger. So here, up, and then back down, yeah. If this is the peak. And you can see the retrace. You can see the retrace already happening there. Let's flick back to the 5 minute. Okay. 10 minute. Okay. There's the 15. Okay. So back to the 3. So let's go to the 4. My internet's a bit slow. Okay. And there's the 55 EMA being the rejection on the 4 hour. There's the 50 MA on the 6 hour. It didn't touch it, but it's there as a resistance. And the reason why I'm going through this is because you can see that slowly the MAs are starting to gather on the different timelines, and the bigger MAs are coming down. Like there's the 144 and the 100, there's the 200. So you can still see on the 6 hour, all these have to come close to price action to stop putting the pressure on. There's the 8, there's a resistance there, and there's the Bollinger as well, by the way. There's the 9, there's the Bollinger, there's the 50 and the 55 EMA. Here's the 12 hour, and there's the 20 EMA and the Bollinger Band. Here's the 18, there's the Bollinger and the EMA. And again, you can see the retrace there. Here's the daily. And the daily is after meeting the medial line. Here's the Bollinger Band, the two top and bottom, and this is the midline. And the medial line can be quite strong at times. So you can see it came to that and got rejected, yeah. And part of it is that you see when the medial line gets broken proper, is price action has a tendency to go all the way to the outer Bollinger Band. The safe is coming down. If the medial line stops it, is great. If it doesn't and gets past it, generally it's going all the way to the bottom. Generally. So there's the daily. Now you can also recognize as well that look, here's the price action, and you can see here's a mountain peak. You know, here's a final peak. Final bounces after taking us quite deep there. It's coming back up. You could even argue that this might be a final peak, but you can see that it's coming very close to completion. Either way, there's going to be a breakout very soon. And then here's the 2-day. That's going the 3-day. I'm just flicking through these. 4-day. Okay. So yeah, that was a green candle. I'm surprised that it even got up as far as it did. You can see that this was a support line. It's after coming back and back testing it here. So this is the white line from all the way back here at 10 cent, 106, 10 cent and 6, all the way back here. Now look at this white line here. So this is why the later time frames are really important. Is you've got, look at this big candle down here, breaks through, comes back up, has a little spike through, and then comes back up again, and then comes back down all the way to here. Now look at this, comes down again, comes back up, and back tests this white line. So now look on the 6-day how you find that this is back testing this white line. Okay, where if it holds, that's a sign for continuation to the downside, because it back tested it and it held. So now here we are, is on the weekly, here's the 100. So this is where why is this happening? Is because look at the weekly got a spike through on the 100, and again here's the rejection of it, and it's after pushing back up. You know, and then here's this line here that's now a resistance line where it was a support line. Get the breakthrough again, is breakthrough again, and here we are. It is as a resistance. As it stands, it's resistance. So now what we're looking for is this now to start to work its way back down through and to break this 100 MA on the weekly, which is at 60 cent. Okay. Now, what's given this line strong support with regards to resistance? I think the 55 EMA on the 2 week, this blue line on the 2 week, is also now a resistance for price action. It's pressing down now. Here's the 3 week. This is a biggie as well. Is look at when the orange 5 MA broke the 20. Is look at this big candle here, yeah. Now on this one, the 5 is after breaking the 20 EMA. So the 20 EMA basically moves easier than the 20 MA because it's more responsive, because it's more up to date. So this moves faster because there's less lag on it, if that makes sense. So now look how much the 20 EMA is actually turning with the 5 here. Now while the 5 is breaking it, it's also showing you that the 20 EMA is actually putting quite a bit of pressure on there, yeah. Just zooming out to the month for a sec. Now, one of the things I am quite cautious about, yeah, is the month is going to change. The month is going to change in 9 minutes. Now, one of the things I'm cautious of here is this red line here. This red line here is the Bollinger Band. Okay. Is the medial line of the Bollinger Band? Is the medial line of the Bollinger Band. So the 5 MA is going to break that. Is when this turns, yeah. Is look at the length of this candle. Is I'm mindful that when this turns, will this candle turn green first before it comes down and goes red? It depends on how much the 5 comes down and is applying pressure, yeah. So what I'm anticipating is that you get the push down, and the initial start of the month is the final push down, and that after it gets its final push down, that's it, it's done. If you look at the month, the bottom of the Bollinger Band on the month is 27, 28. I don't necessarily think it's going to go down this far. It could come down to the 32, as we were talking a lot about it coming down to the 48, the 44 with a spike through. So it does seem like there's one more push to go, and I think the next month candle will actually end up. I reckon it'll end up being green, but it'll be red for the first week or two, and then maybe it gets its retrace and it ends up being green by the time the end of next month. So I'm just watching. I'm watching closely how the MAs behave, in particular this 5, what way this 5 comes down on the month. So, has anybody any questions? So essentially, price action is going to change in 6 minutes, and it's looking like we've topped out on an Elliott wave, and like you can clearly see it. You can clearly see that it's topping out. There we go. There, we're back to the 5 minutes. Remember I was saying to you about it was 20 minutes, and let's see how these are going to behave. So we've got a red, we've got a red, we've got a red, we've got a green at the moment. So this, as it stands, it looks like it's is moving into a retrace, but it's only the 5 minute. It's only the 5 minute. So yeah. So any thoughts or questions before we wind up? Everybody's been particularly quiet tonight.
We're good.
Okay. Just give me a bit of feedback on generally how has tonight's discussion affected your mindset with regards your approach to your trading? Is generally what's your response?
To look at the bigger picture for once.
Okay.
To look at the bigger arcs for once.
Yeah. It takes a bit of it does take a bit of a challenge to do it, you know.
You've been saying that from day one, and
I have, yeah. But I know
as a newbie, I guess you get anxious to do swing trades and other types of trades to make money, and you find success. But then you realize that it's so rigged, or the market makers are so computerized, that you're far better off. I understand what you're saying. The more experienced traders,
yeah,
they're in it for the long haul, the 4 hours, the day, the daily. They look at the bigger picture.
Yeah, because it's harder to manipulate a bigger price move than a smaller price move, because the pattern's happening over a longer period of time, so you can rely on it more. So, and it makes the trades less risky, you know. But it takes longer for them to play out, and it takes a bigger commitment for a person to start getting into that. And at the start, it's too much to expect to do that. People have to get experience, but it's good to hear it from the start, because the more you hear it, as you say, the penny drops a little bit more all the time, and slowly you start moving into that, you know. So yeah. Okay, great. Well, guys, thanks for this evening. Is I suppose my final point again about the dollar costing in is make it work for you is by being as adaptable as you can. Is pace yourself with your trades, which is back to you're playing the long game. So don't get too caught up in chasing your profit. Is get your position. Position will always bring a profit, you know, and then the more wins you have continually, is that steady flow of profit coming in is what you want. And that consistency, then it doesn't matter if you're doing $100 or $1,000 or 10,000. You've got your consistency, you've got your confluence. You are in a brilliant position then for trading for the rest of your life. So these are the little adjustments that give you the big effect. So what's the smallest little thing that you can do that gives you the biggest effect over the longest time? Is measure your dollar costing in for the long game. Is what's the other thing you can do? Is put the time and effort into learning the different arcs over the timelines to start making inroads into understanding confluence. And the time and energy that you put into that, one, is going to save you money, but more importantly, it's actually going to make you a lot of money too. So it's not wasted time at all, and it's very valuable. So just keep plugging away. That's really what I'm trying to say. All right, so I will chat to you. I think it's Matt's on tomorrow. I'll chat to you on Wednesday. I'm delighted that Clay, Exit Strategy, is doing sessions now. And then Mihaela, Crypto Clear, I think she's back. I think she said the 10th maybe. She's back next week or the week after or something like that. And she'll be doing session as well. And again, anybody else along the way, if you'd like to be a coach, is just keep plugging away. And a couple of things that what am I looking for with the coaches? Good TA, solid TA, and that you're making it your own, so to speak. We all need to have a backbone with regards to the arcs and the language. And then outside of that, there's the uniqueness to all the other indicators we bring. And then, so consistency, and then confluence is, I always want to make sure that you have an understanding of confluence. You don't have to be perfect in it, but that you have an understanding of it, you get the concept, and you're beginning to map it out. Because you're already moving into being a mature trader when you've got consistency and confluence. And look, there's the VWAP kicking in there. So now look at this. Is you got this on the 5 minute anyway. It's clearly a correction on the 5 minute. Okay, so now with the VWAP here like this is normally. Now, it's been different lately, but I'll tell you normally what happens is that for the first minute or two, you get a little colour, then the VWAP for the first minute or two will go one colour, and then after 2 or 3 minutes or so, it turns and it's another colour. So whatever colour it is at the start, it normally doesn't end up being that. Okay, so if it's red there, normally it'll turn green, yeah? However, this price action now, the way things are behaving, there's a lot of indicators that are becoming not unreliable. I don't think any indicator becomes unreliable. I might have said there some indicators are becoming unreliable there a couple of weeks ago, and I've been thinking about it. It's not that they're unreliable, it's just the way to read them needs to be read differently. We have to adapt. Like with the RSI is giving us lots of the RSI was giving us lots of overbought, but then it was staying in it when it wouldn't normally. Well, that's not, the problem isn't with the RSI, is us recognizing that the terrain is different. The price action and the way it's moving is in a different form of the pattern, where we have to be able to be more adaptable to recognize what the indicator is telling us. So the indicators behave one way in one type of price action. They behave another way in another type of price action. The indicator isn't wrong. We just need to be able to identify that the different parts of the pattern is the indicators read a little differently. And this is an example. Before I would have said, oh, that's red. We're 2 minutes in now. That's not such a good thing. Is because only very seldom I would see whatever colour it goes at the start it stays at. I would see that seldomly, where most times it's the way I said it. However, lately and again, I think because of the nature of where we are in the pattern, I've seen this happen a couple of times lately where it goes red and it stays red. And I still have to get used to seeing it doing this as often as it's doing it at this point in the pattern. Now, it's probably going to make a feckin' liar out of me now and turn green, but what I'm trying to say is that it is in a correction, and in 5 minutes time, or less than 5 minutes, this VWAP will go sideways, and we'll see very quickly. This is why sometimes I'll spend quite a bit of time looking at the 5, because it literally is the tip of the spear. Is whatever I want to see happen on the hour. So if I want to see the hour turn and it do its correction here, I will see it happening earlier on the 5. So if I don't see it happening on the 5, it's not going to happen on the hour. If I see it happening on the 5, okay, it's happening on the 5. Okay, is the 10 following it? Okay, if you see it on the 10, an example is An example is I want to see the 10 MA here turn. Look at the 5 is turning. I want to see the VWAP is going to go sideways. In 45 seconds, the VWAP will go sideways. I want to see what this 10 MA does. I would love to see the 10 MA turn, but often what happens is that the 5 will cross, the 10 will come up, and it'll do this sideways thing. There'll be a push and pull, you know, and then what will happen is that the 10 will come up, the 10 will come down, and then the 5 will come up. And then it'll be a bit of push and pull. And then what will happen is the 5 and 10 get into a position where they both turn down together, and then they'll come down and they'll start putting pressure on the 20s. And then the same drama gets turned. The 5 and 10 are pushing on the 20. The 20 is coming up. Is 5 and 10 will push it down, 20 will push it up. The 20 they'll turn down, but the 5 and 10 will turn up. So there's that whole crossing, obviously. There you go, look. The 5 is coming down, the 10 is coming up, and the VWAP goes sideways. You know, so I wouldn't be surprised to see a green candle, you know, and if it doesn't happen this time, soon there'll be a green candle, a bit of a push up, you know, and then you'll see it coming back down again. So this is a dance that goes on all the time, you know. But my point is, it has to happen on the 5 before it happens on the 10. So look, there's a red candle. Now it's quite possible, because this shot up like this, is we might get a nice bit of volume pushing down fast. That'd be nice to see, wouldn't it? Get a lot of action down there. Is if we look on the 15, if we look on the hour, it'd be nice in the hour to get a lot of red down here. That would be nice. So as I was saying, is go on.
Could you have a look at the monthly, since it's already changed and you were thinking about?
Yes, of course. Yes, we gotta.
Yeah.
I forgot it's the 1st of February, eh? Okay, thank you for reminding me. Okay, so now. Okay, now look how much. Look at the 10 here. Look, the 10 was up here. Look at that for one move on the 10. So that's a big move. That is a big move. The 5 is here. 5 has come down as well. So 5's not as big, but again, it'll stretch down. These will move over time. But the 10 breaking through the medial here, the 5 breaking the medial, I wasn't anticipating the 10 to do this. So this is a big move. So there's the look at the 20 EMA is coming down more. And again, here's the 20 MA, still rising up a little bit. Again, it moves slower, turns slower. So yeah, so that's and then there's the VWAP coming down. So that was interesting, because I thought the 10 might. There's nothing. They've all turned down rather than turned up, so to speak. The 20 is continuing, but look, down, 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 down. Just continuing up a little bit. I don't think the 3-week turned there, did it? No, the 3-week turned the other day. The 2-week turned. Look at that. The 2-week turned. Let's go. Let's see what's going on the 2-week. Oh, did it? 31st. Oh, that changed. That just changed now.
That was yesterday.
That was yesterday. Yeah. Yes, it was. I was getting confused. Let me just flick back to the 5 just to see. Okay, yeah, there's a little bit of green. Okay, so the 2-week is yesterday. The weekly. Oh, the weekly's not going to turn. The 6-day hasn't turned. The 5-day, no. The 4, no. 3, no. 2, no. The 1. Okay, let's have a look at the 1. Okay, so the VWAP on the 1 is has come up. The 10 is turned, the 5 is turned. And this is where I look at this, they're scooping. Is this was a down, this was an up. Yeah. Yeah, it looks like it's going to go down. It looks like if this comes down, is the VWAP will move, and then the 5 and 10 can become resistance. So, although now if I, yeah, there's the medial line as well. Okay. So if this were to go up, there's the Bollinger Band at 63.6. There's the 20 EMA at 66, and there's the 20 MA at 67. But the fact that we've had a lift here, and remember this is the peak of an Elliott wave, this is a correction, is again, I'm expecting this to go down. Here's the Bollinger Band here at 59. That's the challenge, is breaking this Bollinger Band on the daily, is getting down and getting past the support lines here, and also then the 800 MA here at 55. There's the medial line of the green channel at 52. So let's see what the 12 hour is doing. Or there's the 18. The 18. Again, there's the 5, the 10, and the 20. Do you know, it's so volatile these days around here that this can be an excellent support and it can be an excellent resistance. So the fact that we've had two candles come up, and again this is a correction of an Elliott wave, it's indicating that it's coming down. As much as this looks like, oh, this looks like it's lifting up, is you got to think about, well, what's happened here with regards to the Elliott wave, and now there's a correction due in, yeah. So here's the 12, and again looks a bit similar to the 18. Now this would be interesting, because if this price action gets down far enough, is this VWAP, the yellow line, will bend. It was very adaptable here now. So if this gets down far enough, this will just turn down like this. It'll just flick. It'll flick, you know. Here's the 9 hour, and again hitting the resistance on the way down. You can see this is the thing. Is remember we talked about the foot. There's the heel. Here's the arch. Here's the ball. You know, the toe. But look at the Bollinger's getting tight there. So this is all the on the 9 hour they're getting tight. It's setting up for a breakout. The 8 hour is the same, yeah. And again, it's coming down. Not whether it's breaking down right now, but you can see I thought this was it. Then we've got this fecker here, and we're going to get a come down as well. So pushes, and here we are on the downtrend again. There's the 6. Now what I'm looking for as I go through this, you see the foot, there's the heel, here's the arch, here's the big toe. What I'm looking for now is what MAs came down and are applying pressure here. So you can see as we go through, the MAs are up here, but as we go lower in the time frames, look, here's the 50, but it didn't touch, so it wasn't the 6 hour that rejected it. Now we have a rejection here on the 55 EMA on the 4 hour. And again, the Bollinger Band's getting tight. Here's the big toe being made in the 4 hour. And again, here's the 3 hour. There's the 100 and the 144. This didn't seem like it was needed. The 55 seems to be doing it. That line there being a resistance. Again, tight Bollinger Bands. Now you could talk about a cup. See the cup there? Cup and handle. Okay. There's the 45. There's the 30. Okay, so again, there's the 15. Look, there was a retrace. Here's a retrace here. Okay, so look, there's the 5 there. Ah, see, this is telling now. This is telling. Look at the angle of the VWAP. Why is this coming down? Why is the red coming down so strong here at the moment? It's because look at the VWAP here. See when the VWAP goes at an angle like this? The VWAP could have gone sideways. Just could have gone sideways. Most times you see it going sideways. When you see it coming down at an angle like this, there's more intent in it. It's more active. So it's not a passive resistance here. This is actively pushing down rather than just a line that's sort of like a block, like it's when you get to it, it pushes against it. This is actively pushing down simply because you can see and again, it's working its way. It's moving down, not so sharply here, but it's moving down. But the fact that it's sharp here is telling you that it's actively pushing. Now, what I'll be looking for is there's the 15. You see what I mean? The 15 is more neutral. So now the question is if the 10 keeps actively pushing so much, if the 15 gets a good candle down, I'll be watching to see if this VWAP comes at a sharp angle down like this. Because if it does it on the 15 and then it does it on the 30, again, I'll be watching the whole thing. Will it do it on the 45? Do it on the hour? Will it happen on the 2 hour? So, and you could get a cascade where the VWAP is just pushing down. And what happens is that the VWAP will eventually spill and become the lead. And the VWAP starts to do the push down, which is the craziest thing I've been telling you the last while about price action, is the VWAP is the one that's leading the push rather than the 5. It's an odd one, and I reckon it's just where it is in the pattern. But the VWAP is one of those that's behaving very differently than normal. So, okay, so listen, I'm going on and on and on here. So let's finish up. And look at this on the 15. We're getting the wave trend lighting up here. So nice push down. Okay, guys. Thanks for this evening. I'm hoping that just a couple of more pennies drop for you. You get a little bit more refined in your trading. And again, tonight's session, I'm hoping that you got a little bit more think about the long game and start to the dollar costing in. Is you're doing it that way because you're playing the long game. It's giving you position with less stress. And then looking at the hours and the 4 hour, the bigger arcs, looking for confluence, is start to study the confluence of your trades. And that will give you the confidence to know when to go in and when to hold and when to just let it play out. That's one of the skills of trading on the hour and the 4 hour. You're in the trade for longer, but you're letting it play out. And you're TAing it, but you're just letting it do its thing. And you're letting it find its way to where you know it's going to go. So very good. Well, listen, enjoy the rest of your day, the rest of your night, and I will talk to you very soon. All right. Cheers.